You've got quite a rosy outlook for next year, don't you? Global economy.
Yeah, very much so. When you look at the global economy, for the first time in many years, you've got the entire global economy growing at an above-trend rate of growth. And the risk to that is that growth is stronger, not weaker next year.
When do tighter labour markets lead to wage growth? That's one of the big, some might say, unanswerable questions out there.
That is the million-dollar question. But the reality is a very interesting thing happened this year. Look at investment spend in economies. When you look at investment spend across the globe, it's like a rocket shooting up. And, of course, when you get more investment spend, what you then get is productivity gains. In theory, you can then get some wage growth. Let's see. That could well be a theme as you look into 2018.
In this global synchronised growth scenario, Nick, how do the key central banks behave and what's the knock-on effect for your asset class?
Well, certainly when you look at central banks, markets are hugely underestimating what central banks are likely to do in terms of tightening monetary policy. So when you look at the Fed, certainly 3 or 4 rate hikes is eminently reasonable. And the big risk comes when you look at the ECB. The risk is the market prices the ECB going from emergency levels of rates just to low levels of rates. That means minus 40 could go to 0.
So how do you factor in the credit cycle into all of this, Nick? Where are we in it?
So when you look at credit, we are mid-cycle, not late cycle. When you look at things like the operating leverage for companies and operating results, very, very favourable. When you look at things like default rates, the risk is they stay low and indeed perhaps tick a little lower. If you think what causes higher default rates, it's typically that risk of recession. We would argue that is very, very low.
So what's attractive in that space then? Do you need to stay sort of at the top of the range, the AAAs, the top-class corporates? Do you need to go down the ladder a little bit?
Very much down the ladder. So when you look at the credit space, the real juice is things like high yield. When you look at high yield in the US, yield of around 6%, a credit spread still of close to 4%. No reason that credit spread over 2018 can't be 1% lower.
There was a high yield, what should we call it, a wobble last month. Just a wobble? Was that a precursor to further wobbles in 2018, Nick?
It was very much a wobble, and it's clear when you look at credit investors, they're climbing that wall of worry. When you look at that wall of worry, though, it's probably a lot higher than many people think. What does happen in 2018, though, and what caused that wobble was volatility. We're used to very, very low volatility. The risk is that volatility increases next year, actually as central banks continue to withdraw monetary policy.
And on banks, you like European bank capital, don't you?
Oh, very much so. When you look at Europe, the international success story this year in terms of economic growth, when you look at banks in Europe, in aggregate, they've done a great job of raising equity, writing down bad loans. So there you're paid to go right down into those cocoa bonds, right down into the junior bit of the capital structure.
How does the ECB's corporate bond buying programme, maybe in the second half of the year, maybe when it changes tack, how does that knock on into other parts of the credit market, Nick?
So when you look at investment-grade bonds in Europe, at an all-in yield of 65 basis points, difficult to argue that represents screaming value. So the risk, again, there is maybe yields there do go gently higher.
What about sovereigns? I have a great chart here in the Bloomberg. It's in the chart library at 58.84, where you see the spreads to bunds. And we're really talking about 32 basis points for France and at the most Italy at 151 basis points. Anything attractive to your investors there, Nick?
Yeah, very much so. So when you look at Italy, absolutely the standout sovereign peripheral spread in Europe. An interesting thing happened to Italy this year. For the first time in 22 years, Italy was upgraded. Remember, rating agencies often a lagging indicator. That tells you growth is back in Europe, and particularly in places like Italy. So as you look at that spread around 150 basis points, our sense is it could go down to 90 basis points. Again, sounds aggressive. It's only where it was in 2015. Italy's in much better shape than it was in 2015.
And then in terms of industries, are there particular industries where you think, you know, we might still have a chance to get in? I know a lot of people were very negative on retail, but it's taken a long time for US retail stories to play out. Is it similar in Europe, for example?
Yeah, no, pretty similar in Europe. When you look in Europe, the real focus actually is still banks. And banks offer the greatest value there. The interesting thing also in Europe, though, is that the real action is behind the index. So you're not seeing much movement in the headline credit spreads, but behind the index, you're starting to see a lot of dispersion. So it's really a bond picker's market for 2018.
We heard Neil Kashkari's take of the flat yield curve. What's the Nick Gartside take on the yield curve and what it possibly tells us?
So very much it's likely to continue to flatten in that environment that we at least paint: strong growth, inflation maybe ticks up a little but doesn't get out of control. So that yield curve continues to flatten, but critically it doesn't invert. And it's not so much a flat yield curve that's that indicator of recession, it's that inverted yield curve. And we're still at 50, 60 basis points. We're a heck of a way still from inversion.
EM bonds, 2018, I mean, EM assets have been all the rage in 2017. Surely they can't replicate that performance next year.
They're likely to. It depends. Remember, not all EM is equal. But when you look at local EM bonds, so denominated in a local currency, they're really a geared play in terms of that economic growth. If you think of yields in some of those countries, double digits. When you look at a Brazil, a South Africa, a Turkey, so you've got a nice bond yield there. The risk also is the dollar's a little
You're
weaker.
encouraged by yesterday's ANC vote in South Africa?
Very much so. When you look at countries like South Africa, Turkey, Brazil, very much in the buy zone.